Kit, in the past, in 2016, when we saw substantial weakness in the yuan, you saw state-owned banks step in to support it. Are we now looking like we're heading at that level again with these sort of piecemeal type actions?
Yeah, you get the impression that that the Chinese authorities don't particularly want a weaker currency. It doesn't help them. They've tried in the past to use it as a solution, and the side effects are worse than the benefits. Is I think the judgment. But they clearly have a problem. I mean, they have an interest rate problem. If they want to cut them further, rate differentials get bigger. They have a growth problem, and they seem to have a capital outflow problem that's getting bigger again now. So, yeah, they'll smooth it. I'm not sure they can stop it weakening. I think that's kind of, so they'll probably just try to keep control of the situation.
Paul Dobson from our MLive team had this really great quote, basically likening what was happening in China to a colander, trying to fill up water in a colander, that as much as, local people put money into the market, international money is still going to flow out. Is that fair?
Yeah, I mean, when you're starting with a big current account surplus, you typically you're in a position where you have a fair amount of control over where your currency is. When you've got as many foreign exchange reserves as they have, likewise, you have a fair amount of control. But you have to be very hard-headed about going in with a big hammer to try to stabilize things. And I think that it would look to me as though the end decision is not quite colander, but it's just kind of massage the move. Yes, we'd like it not to happen, but we're not going to cause lots of mess to try to prevent it.